Welcome everyone. Thank you so much for joining me. If you haven't already, please consider subscribing now and to make sure that you ring the bell to turn on video notifications. For millions of Americans trying to save for retirement or stretch their nest egg just a little further, every dollar matters. And right now, for the first time in years, a sweeping new package of tax changes could actually give retirees and near retirees a powerful financial boost. These changes are part of the One Big Beautiful Bill, which was signed into law on July the 4th, 2025. And when the 2026 tax season arrives, these new rules could significantly reduce your tax bill, your tax liability. What makes this moment important is very simple. Most people approaching retirement are juggling rising costs, uncertain markets, and the challenge of making their savings last for possibly decades. These new laws actually offer several major changes that will help you lower your tax bill. The first major change affects nearly everyone: a higher standard deduction. Normally, the standard deduction rises every year to keep up with inflation. By this time, Congress has added an extra 5% bump. For the average married couple filing jointly, that means an additional $1,500 of their income won't be taxed. And for people 65 or older, or for those who are blind, the deduction gets even bigger. It is an additional $2,000 for single filers, or $1,600 more for qualifying spouse on a joint return. And if you're both 65 plus and blind, the bonus doubles. So these numbers may sound small, but tax savings compound just like interest, and every dollar capped is a dollar earned. The second tax change is even more noteworthy: a brand new deduction exclusively for taxpayers over 65. If you're 65 or older by the end of 2025, you may qualify for a deduction of up to $6,000 on an individual return, or up to $12,000 for joint filers if both spouses meet the age requirement. But this benefit is actually income tested, so for individuals with a modified adjusted gross income over $75,000 or couples over $150,000, the deduction begins to phase out. Those with higher incomes won't receive the deduction at all. Still, for millions of Americans living on Social Security, pensions, and modest investment income, this new deduction could make a meaningful difference. Next comes a surprising addition: a new tax deduction for car loan interest. Here's how it works. If you bought a new car, I should specify, in 2025, and you took out a loan to do that, you can deduct up to $10,000 of the interest you pay that year, so long as the car was assembled in the United States and weighs under 14,000 pounds. This deduction is also income-phased, starting at a modified adjusted gross income of $100,000. That's when the phase-out begins for individuals, or $200,000 for couples, and it disappears entirely once you cross $150,000 or $250,000 respectively. For retirees living on fixed incomes or replacing an aging vehicle, this deduction could lighten the cost of a major purchase. The fourth major change affects retirement savers still in the workforce. For 2025, the limit for contributing to a 401k, 403b, or 457 plan rises to $23,500. By the way, I have an entire video on the changes to 401k contributions. I will link that video below. You must watch it if you have a 401k and you want to understand how the Big Beautiful Bill affects it. Those 50 and older can actually make an additional $7,500 catch-up contribution to their retirement accounts this year. But here's the game changer. If you are between 60 and 63, you can make a supersized catch-up contribution of up to $11,250. That means that you can contribute as much as $34,750 to your retirement plan in a single year. For people nearing retirement who still have strong earnings, this is an enormous opportunity to build savings and to lower taxable income at the same time. And it's not just retirees who actually benefit. The Big Beautiful Bill introduces a new deduction for tipped workers, something that could help older Americans who pick up part-time work to make ends meet too. If you work in a job where tipping was customary before 2025, such as serving, bartending, hairstyling, rideshare driving, or hotel service, you may be able to deduct up to $25,000 of cash tips. There is a key restriction though. You cannot work for what the IRS calls a specified service, trade, or business, which typically includes fields like law, accounting, consulting, athletics, and even financial services. The deduction also phases out for high earners, beginning at an adjusted gross income of $150,000 for individual filers or $300,000 for couples. It disappears completely once you hit $400,000 and $550,000 respectively. Another new option is the overtime pay deduction. If you are still in the workforce and working extra hours, you may deduct up to $12,500 or up to $25,000 for joint filers of overtime pay from your taxable income. Like the tip deduction, the overtime deduction phases out for higher earners, and it requires joint filing for married couples. It is designated for workers who rely on overtime to supplement income, including many older Americans who are not yet ready or willing to retire. Taken together, these changes that I just walked you through add up to something significant. They do reflect a growing recognition that retirement realities have changed, and many Americans are struggling. Americans are living longer, they're working longer, and they're facing higher costs. So traditional pensions have largely disappeared, and Social Security, of course, it is a vital source of income for many, but it is not enough on its own. The new tax provisions aim to give retirees a bit more flexibility, more room to save, and more control over their finances. While some of these deductions expire after 2028, and I will walk you through that in a separate video, their impact could be felt long after. So from larger standard deductions to expanded retirement contributions to targeted support for workers who depend on tips and overtime, the bill creates a temporary but quite powerful window for financial planning and opportunity. And for those willing to take advantage of it, the 2025 tax year may offer opportunities that won't come around again for decades. As the 2026 tax season approaches, this is the moment to pay attention. New rules, new deductions, and new strategies could help you keep more of what you've earned and bring a little more peace of mind to the years ahead, hopefully. Recently, I uploaded several new videos on how to lower your tax bill. Check them out next if you would like to take advantage of tax savings. Stay tuned for new updates. I upload videos on a weekly basis. Remember to subscribe, enable notifications by ringing the bell, and I will see you back here soon. I hope you have a wonderful day. Take care.